Not many people know this, but there are actually two different ways you can profit when buying call options. And in this video, I'm giving you a deep dive into how they both work, when to close versus exercise call options, the difference between those, and where to set your stop losses to make sure you lock in as much profit as possible. Sometimes the math is a little confusing, so this is a deep dive with an example so you can follow along, see how call options really work, and understand the fundamentals of why the call option moves when the stock price moves as well. Right inside of Interactive Brokers Trader Workstation, we are looking at Coinbase. This is going to be our case study for today. The Coinbase stock just closed at $55.40 per share, end of day Friday, June 16th. So this is the example we're taking from today. We're going to be looking at the call options for July 21st, 2023. So roughly 35 days till expiration. We are targeting this $60 call option right here and looking to buy it at the middle between the bid and ask. So calling it between $375 and $385, looking like a $3.80 buy to buy this option. We're also going to be noting that the delta here is 0.435. This is going to come into play a little bit later on, and it's going to be crucial for you to calculate how much potential profit you have as this trade progresses. And now we're going to switch gears and open up a trusty spreadsheet. It's my engineering background by trade. We're going to run some numbers on this so you understand the difference between exercising and closing off the call options when they're profitable and what each one entails in terms of how far the stock has to move. So in this spreadsheet, right now we're looking at the ticker of Coinbase, which we said, the current stock price of $55.43. Those are our baselines. And we have this purchase here potentially of 5 contracts, right, of the July 21st coin $60 calls. We are buying 5 of those contracts. So we are buying to open. And in this case, we're hoping that the price of Coinbase goes up. If it does, we make money. But most people get this wrong. You don't make money exercising the contracts right away. You actually make money when the options contracts themselves change in value. But let me show you first what most people think happens and how it actually doesn't. This is the big mistake most traders make at the beginning when they're losing call options. When you have this 5 contracts, right, your average price, we said of 380, that was right in between 375 and 385. So we're going to buy 5 of these contracts for 380. So totally, this is going to make us a cost basis or an acquisition cost of $1,900, which is just 5 times 3.8. That gets us our $1,900. That is our purchase price. If we are going to exercise this call options, we'd end up having 500 shares in play that we would go up and buy for $60 per share. Depending on where the stock price is, this could be a good or bad move. The overall, again, market value is $1,900. And now we have to look at a scenario where if the price goes up like we want it to, and if it does exercising this call option make sense? Now, remember, when you buy a call option, you buy the right to purchase 100 shares at a given price, the strike price here. So we are buying the right to purchase shares at $60 per share. So this only makes sense, and this will only work if you're going to exercise this contract. And exercise just means to buy those shares. If the stock price goes up past $60, but it doesn't just have to go past 60, it actually has to go a lot higher than $60 compared to where it's at right now, 55. So where does it have to go? Well, in this first example right here, if we exercise this contract, if the stock price of Coinbase gets to $60 per share, would it make sense to exercise this contract and buy those shares? Not necessarily. That's like those numbers. If we bought the 5 contracts for $1,900, the cost to purchase 500 shares, if we were to exercise, right, would be $30,000. Okay. We would buy 500 shares times $60. That is $30,000 to purchase those shares. That's how it works. That's what you're agreeing to do if you want to choose to do that. The Coinbase stock at its example in this kind of theoretical out in time is $60 per share. Okay. That's what's trading at currently. Let's say it goes in a bit of a heater, up from 55, 43 to 60. So the current market value of 500 shares, right? This is different than our acquisition cost. We can buy them at any time we want to at that $60 mark. But the market value it's being traded at is now $60 per share. So if we were to buy 500 shares for 30 grand and we could turn around and sell them for 30 grand, we would make no money. Not ideal. We would actually lose money in this scenario because of our acquisition cost or our cost basis to buy those 5 call options. We paid $1,900, remember? So we would buy the contracts and buy the shares themselves for $30,000. We would sell them for $30,000, and we would still be on the hook after paying that $1,900 out of pocket at the beginning to buy these call options themselves. So we would be right down here with a profit, in this case, a loss of negative $1,900, which is just the negative kind of capital that we used to open up this trade. So even if the stock price of Coinbase goes up to $60 from 55.43, it does not make sense to exercise. What it does make sense to do, though, is to close off the contract itself and not exercise it, assuming that this price goes up to $60 per share before the expiration date here on July 21st, 2023. This is how the options contract itself is going to change. So we're going to take this 380 right here, and this is how it's going to maneuver and make you positive, make you more money. We look at the delta, which you talked about, was 0.435, okay? The delta, again, remember, is just that it's one of the Greeks. It's in this column right here. If you don't have that, turn it on in Interactive Brokers. Make sure you understand what the deltas mean. What they do mean is that when you have a delta, it is saying that for every dollar that Coinbase goes higher, the contract or this call option contract is going to increase by 0.435. So if the contract or if the stock price of Coinbase goes up by $1 right here, the options contract, this call option contract would go up by $0.435. Okay. And in this case, the stock price went from 55.43 up to 60. Okay. So the rise in stock price is just $4.57, which is 60 subtract 55.43. And it gives us a change in our call value in one single call value. It's going up by $1.99, which is just the multiplication of 0.43, the change in the delta, times the rise in the stock price. So every dollar it goes up, that $4.57 rise up, we're capturing almost $2 of that rise. And we're not capturing the full thing because we didn't pay for the full thing. The only way you capture the full thing, the full $4.57, is if you were to buy the shares outright. Since we didn't, we are not entitled to capture the full stock move. So we capture partial of it, 43% of it in this case, and it goes up by $1.99. That makes our current market value for one of these call options that we're holding $5.79. So it changes by $1.99. We are adding that $1.99 to our initial price here of $3.80 to get us a total of $5.79. Okay, stay with me here. This is where it gets exciting. The market value, we're going to take that $5.79. Okay, we're going to multiply it by 5 because we have 5 contracts, and we're going to multiply it by 100 because we have 100 shares in each contract. Doing this gives us this pretty little number right here at 2893.98. You can see the equation right there. We're multiplying it by 5 because of 5 contracts and multiplying it by 100 because of 100 shares per contract, giving us a total of 2893.98, which is a profit, right, of 993.98. So what you would do in this case, you wouldn't exercise. You wouldn't do this. That would be bad. You'd be going over here and you'd be losing money. But what you could do is just close off your position. Remember, you bought to open at 1900. You could then sell to close and sell this 5 options contracts, these call options, back to somebody else out there in the trading world and make a profit of $993.98, which is just the difference, remember, of your market value once the stock price moves, the difference between that and the $900 that it cost you to buy this stock option contract in the first place. So total profit here at 993.98. That is closing versus exercising. Those are different things. Understand the difference. If we take scenario number 2, where the stock price of Coinbase goes up even higher, okay? If you were to get the price of Coinbase up to $65 per share, right? Everything from up here still stays the same. We still bought these call options for $1,900, and we can turn around and buy 500 shares at that $60 price. That's what we agreed to do, at $60. When the stock price reaches $65 and we buy for $60, we're going to make some money. This is good. This is what happens when it's good. We're going to get paid the difference between $32.5, which is the current value of the stock price of $65. That's what we can sell them for. We can buy them for $60, which is our $30,000 acquisition cost right here. So we have a difference there, a profit of $2,500. Okay. But we don't get to keep all of that because, again, remember, we ended up paying $1,900 to buy these call options in the first place. So we had to subtract that from our overall profit on the selling of the shares for a total profit of $600. Okay. Not that much when you compare that. You made $993 over here in this closing of the stock of the options versus exercising here with a $5 extra move. So $600 in potential profit here if we wanted to exercise and buy those shares and turn around and sell them on the market. In the other scenario, I'm going to come back to this in a second to tell you why you might want to do this, even though it doesn't make as much sense as you might think. So if the stock price goes up to $65 and the options in Delta is still 43.5, the rise in stock price now is 9.57, which means if we go 9.57 times 0.435, we get a change in call value there, the 4.16. We add that 4.16 again to our initial average cost of 3.8, and we get the nice tidy 796 for one call option. Multiply that by 5 again and times 100. The current market value, if the stock price of Coinbase in this example goes to 65, would be somewhere around $3,981.48, giving us a profit, if we were just to close the contract before expiration, of $2,081.48. That is these 398,148. Subtract your $900 acquisition cost that you paid for those contracts in the beginning. The contract values have gone up. They've gone up by the relative number by the delta, and you can now turn around and sell them to somebody else and make a profit of over $2,000 very tidy, very quickly. Now, why would you ever want to do this versus doing this when this is obviously more profitable and you can do this at any time when you have profit showing in your contract? Well, if the stock price is on a heater and it's projected to go even higher, but you're getting very close to this expiration date of July 21st, maybe July 20th, and you need to exercise or need to close, and you don't want to close and take the profit because you want to actually get the shares in your account and think that maybe this price is going to go higher. If you think it's going to go up to 75 or 80 or 90 bucks, and you want to actually buy those shares and have them in your account and ride this appreciation wave up, okay, you could forego these profits here. You could exercise at your $60, right? Because you bought it for 60. You could exercise at 60. So $60. So again, you're going to pay up 30 grand right here. And then if the stock price does hit 90, right, you wouldn't turn around and sell these shares right away. You would keep them in your account. And if the stock price did hit 90, you would then go 90 times 500. You'd have $45,000 in market value. We're going to subtract 45 and take 30 grand off it because that's what we bought the shares for, right? And then you can potentially have profit of $15,000. If this takes a few more days or even a week after the expiration date of your option up here, you wouldn't have the option to close because your option contract would have expired, which you don't want to have happen. So sometimes it does make sense to exercise and buy those shares and not turn around and sell them, because obviously here, you're not making as much profit as you are in this scenario. So it really depends on where you think the stock price is going to go next. And this is the difference between exercising and closing, what you really need to know. But if you have more questions, make sure you leave me a comment and just give me an idea of where you want me to go in depth more and where you want me to spend more time with. To me, it's kind of cut and dry. I've done this a couple of times, but to somebody else, it may not be making the most sense. So just let me know what you're struggling with if you are, and I'd be happy to break it down in another way or show you kind of a more visual example. I know this is math-based. Not everybody likes math all the time. So that's something I can definitely do for you if you want that done. In terms of setting stop losses for these contracts, what you want to do is always go into a trade with an idea of how much profit or percentages you're willing to give up. In this case, you're not buying shares, you're buying contracts. So if you wanted to set a stop loss for this kind of trade, you wouldn't be doing it based on the stock price of 55.43. You'd be doing it on the options value here of 380. So if you wanted to set a stop loss here, and you had a target, you always want to have a target, right? Let's say you wanted to wager 10% of your position. We were okay with setting a stop loss at 10%. We would just go our 380 equals 380 times 0.1, right? That's where we want to have our stop loss. So we could then go ahead and subtract this from 380 to get our total stop loss area where we want to set the contract value at. So we go 380 minus 0.38, which is 10%. So we want to put a stop loss at 3.42, and that could be a stop order, that could be a stop limit order, whichever order preference you prefer. I like to use stop orders when I'm looking at options like this. It's just easier and cleaner. It gets me out of the trade right away. The other way you can do this, and the quicker way, if you can okay with the math, is that you can take this number here, this 380, you can go equals 380 and multiply it by 0.9, which is 90%, which means you're going to give up 10%. And you're okay with losing that 10%. And that's going to give you the same number here, that 3.42, where you want to set your stop loss at. Again, stop order, stop limit order, 3.42 right there is a 10% deduction. If you wanted to go 25%, right? We can do the same thing and go equals 3.8 times it by 75, right? 0.75 times 0.75. That's your target then. If the contract value of 3.8 goes down to 2.85. This is going to be a 25% loss. You can set your stop limit there or your stop loss there. You would then lock in your loss and protect your downside, which you always want to do when you're trading any kind of call option, trading shares, whatever it may be. So that is call options. That is exercising versus closing. We've talked about how to set stop losses where, and just basically it comes down to what you prefer to do in terms of closing versus exercising where the stock may go in the future. And on the flip side, if you want to know how to sell covered calls and do the flip side of kind of buying calls, you want to know how to sell calls for profit on stocks you already own to make a very tidy monthly or weekly income, make sure you check out this next video in the series. My name is Andrew. Thank you so much for watching. I will catch you on the next one. Hope you got some value here today. If you did, please consider subscribing to the channel. It would mean a heck of a lot to me, and I will see you later.